Final accounts. Final accounts are the accounts prepared at the end of an accounting period to find out the results of the business. That is, there may be profit or loss in the business or the financial position of the business. So, businessman is interested in knowing whether his business is running on profit or loss. And also he wants to know what is the true financial position of the business. Financial position means assets and liabilities position. So with these objectives in view, financial statements are prepared, which is also known as final accounts. It is prepared at the end of an accounting year, which summarizes all the accounting information. So financial statements or final accounts are prepared to find out the profit or loss incurred in a business, or to find out the true financial position of the business. So financial statement consists of trading and profit and loss account and balance sheet. Trading and profit and loss account is also known as income statement because it is prepared to find out the profit or loss. And balance sheet is also called position statement because it is prepared to find out the assets and liabilities position of the business. First is trading account. Trading account is the first statement prepared in final accounts. It is prepared to find out the result of buying and selling of goods and services. So, trading account is prepared to find out the trading results, that is, the results of buying and selling. So, the result we get may be the gross profit or gross loss of a business, which is the difference between sales and cost of goods sold or cost of services rendered. Let's see an example. So, trading account is prepared to find out the gross profit. So, gross profit is the profit before indirect expenses. That is, it is the result we get from the buying and selling of goods. There are two types of organization. That is, when we are saying of gross profit, we have to consider the types of organizations. Trading concerns and manufacturing concerns. In case of trading concerns, they only buy goods and sells them. But in case of manufacturing concerns, they buy raw material, then makes production process there for converting them into finished products, then sell the finished products. So, in case of trading concerns, then we can calculate gross profit with an example. You see, they are buying 10 pens at the rate of 5 rupees each. That is, the cost of pen is 5 rupees. Then each pen is selling at a value of 8 rupees each. Then their profit is 80 rupees is the selling price. That is 8 into 10, that is 80. Then buying price or purchase price is 5 into 10, that is equal to 50. So their profit is 30. That is sales minus purchases. But in a running organization, there may be closing stock as well as opening stock. So we have to consider this stock also. Then profit is sales plus closing stock. Closing stock means stock at the end of the accounting period which is not unsold. Which is unsold. Unsold stock is called closing stock. So sales plus closing stock minus opening stock plus purchases. Thus, we get gross profit. But in case of manufacturing concerns, I have already explained that in case of manufacturing concerns, they buy raw material, then production process is going on there to convert them into finished products. So, they incur direct expenses. That is, direct expenses are those expenses incurred to make the goods to saleable condition. Goods to saleable condition means, for example, in case of some goods, packing materials are necessary. For example, ink, bottle is necessary for handling it. In case of toothpaste, tube is necessary for handling it. So, these are direct expenses for making that goods to saleable condition. So, these direct expenses are to be considered while calculating gross profit. So, in case of manufacturing concerns, profit is equal to sales plus closing stock minus opening stock plus purchases plus direct expenses. So, for using this formula in accounting, we prepare trading account. So, trading account. How do we prepare trading account? Trading account is debited with opening stock, purchases and direct expenses, and credited with sales and closing stock. You see here opening stock plus purchases plus direct expenses are deducted from sales and closing stock. So in a trading account, we debit opening stock, purchases and direct expenses, and credit sales and closing stock. So the difference between the total of debit side and credit side represents gross profit or gross loss. If credit side total is more, we get gross profit. And if the debit side total is more, the difference is gross loss. So while preparing the trading account, some journal entries are passed, which is known as closing entries. So now let us see the closing entries. First one, for transferring the item to the debit side of the trading account. We have already explained that the trading account is debited with opening stock, purchases, direct expenses. So the journal entry is trading account at to opening stock, purchases, wages, carriage inwards, other expenses, etc. Then next is for the amount of sales. For transferring the amount of sales to trading account. Sales account at to trading account. Then purchase returns account is closed by transferring it to purchase account. So the journal entry is purchase returns account to purchases account. Then sales return account is closed by transferring its balance to sales account. The journal entry is sales account to sales return account. Then for transferring the closing stock account to trading account. And if there is gross profit, journal entry is trading account to profit and loss account. If it is gross loss, the entry is profit and loss account to trading account. The relevant terms in the trading account. We have already explained the items in trading account, opening stock, purchases. Now we can explain all these things. First one is opening stock. The balance of stock brought forward from the previous year is called opening stock. So at the end of the year, there may be unsold stock, which is brought forward to the next year. Next accounting period is called opening stock. So the closing stock of one period may be the opening stock of next accounting period. There will be no opening stock in case of a new business. Then stock may consist of raw material, work in progress and finished goods in case of manufacturing concerns. In case of trading concerns, stock means finished products only. But in case of manufacturing concerns, stock may consist of raw materials, work in progress and finished goods. Next item is purchases. Purchases means the goods procured in the business. So purchases may be either cash purchase or credit purchase. Cash purchase means the cash is paid at the time of purchase. But in case of credit purchase, payment of cash is postponed to a future date. Then purchase returns are deducted from purchases. Like that, discount also will be deducted from purchases. And only net purchases are shown in the outer column. Next, we have already explained that trading account is debited with opening stock, purchases, then direct expenses. Then what is direct expense? Expenses incurred for making the goods to saleable condition are called direct expenses. Then some direct expenses are explained below. First one is wages. That is wages paid to the workers who are engaged in the production of goods. That is factory workers. Without their work, the product will not be made. So the wages are direct expenses. It is to be debited to trading account. Sometimes wages may be clubbed with salaries. And if the item is given as wages and salaries, it will be debited to trading account. But if it is given as salaries and wages, it should be debited to profit and loss account. Next is carriage, cartage or freight. These are the expenses incurred for bringing the goods to the place of production. So carriage is the charge paid for bringing that goods to production area. So these are direct expenses. Without bringing that goods to production area or factory, they cannot produce the goods. So these are direct expenses and these are to be debited to trading account. Next is fuel, power, water, gas, coal, etc. All these are expenses incurred for making the goods in the factory. So these are direct expenses. It is to be debited to trading account. Manufacturing expenses. All expenses incurred in the factory, that is factory rent, factory lighting, etc. are manufacturing expenses. So these are necessary for the running of the factory. So these are direct expenses and are to be debited to trading account. Then octroi. When goods are brought within the municipal limits, so a duty has to be paid which is called octroi. Import duty and dock charges. When goods are imported from abroad, import duty have to be paid. Then dock charges are paid at the port. Then next clearing charges etc. have to be paid. All these are direct expenses and are to be debited to trading account. Next, excise duty. It is payable on the goods manufactured within the country. So excise duty is a duty paid for the goods manufactured within the country. So it is to be debited to trading account. Then next is royalty. It is the amount paid to the owner of a right for using his right. That is, it is the amount paid for using some ownership right. That is in case of if a person makes some invention and he get a patent right for that, and a manufacturer want to use that patent right, he has to pay a sum or amount to the owner. It is called a royalty. Then for another example, in case of book publishing company, that the authors of books may not publish the books. It is usually done by the publishing companies. So authors take copyright for the books. So the publishing company have to pay a sum to these authors. It is called royalty. So if royalty is paid on the basis of production, it is to be trading account. It is to be debited to trading account. If the royalty is based on sales, it is to be debited to profit and loss account. For example, if the royalty is paid on the basis of production, means in case of quarries, mines, etc., the royalty is paid on the basis of production. So in that case, it is to be debited to trading account. But in case of book, then the amount is paid or royalty is paid on the basis of sale of books, number of books sold. Then it is to be debited to profit and loss account. Next is primary packing materials. These are materials which are necessary for handling the product. I have already explained that for toothpaste tube is necessary, for ink bottle is necessary. So these are direct expenses and are to be debited to trading account. Next, consumable stores. Expenses incurred to keep the machine in right working condition. Example, engine oil, grease, cotton waste, etc. Without these things, the machinery will not work properly. So these are direct expenses and are debited to trading account. Sales. Then sales less returns, that is net sales, are credited to trading account. Next, closing stock. Closing stock is the value of goods remaining unsold at the end of the accounting year. It is to be credited to trading account. Then this is a format of trading account. Then opening stock, purchases and all direct expenses are debited. Direct expenses, freight, carriage, cartage, customs duty, etc. Then sales less returns, closing stock is credited. This is the format of trading account. Next is profit and loss account. So financial statements or final accounts consist of trading and profit and loss account and balance sheet. So trading account is already explained. Now profit and loss account. So profit and loss account is a nominal account prepared to find out the net profit earned or net loss incurred by a business during an accounting period. So profit and loss account is prepared to find out the net profit or net loss. It is debited with all operating expenses and losses and credited with incomes and profits. So in the debit side, all expenses or losses are shown. And in the credit side, all incomes and gains are shown. So the differences may be either net profit or net loss. So profit and loss account, the preparation of profit and loss account begins with gross profit or gross loss brought down. which is brought down from the trading account. Then account is debited with all revenue expenses and it is credited with all incomes and gains. Then the balance, that is, if the credit side of the profit and loss account is more, we get net profit. If the total of debit side is more, we get net loss. The amount of net profit or net loss is transferred to capital account. If it is net profit, it will increases the capital, and if it is net loss, it will decrease the capital. This is the format of profit and loss account. So it starts with gross profit. Gross profit is in credit side or gross loss is in debit side. Then all expenses and losses are shown on the debit side. Salary, rent, postage, advertising, that is all operating expenses and losses. Bad debt. Bad debt is a loss. That is, bad debt means any irrecoverable portion of sundry debtors is known as bad debt. So all losses and expenses, legal charges, commission, repairs and maintenance, interest on loan, interest on capital, all these are expenses for the business. These expenses and losses are debited. And all incomes and gains are credited. Commission received, discount received, rent received, bad debt recovered. All these are incomes and gains. And the difference is net profit or net loss. Next is balance sheet. So at the last prepared is balance sheet. Final accounts consists of trading account, profit and loss account and balance sheet. So balance sheet is a statement of assets and liabilities prepared to ascertain the financial position at any particular date. So balance sheet is prepared to find out the assets and liabilities position or financial position of the business. It is prepared at the end of the accounting period. Then balance sheet is called balance sheet because it is a statement prepared with the balances of accounts remaining after the preparation of trading and profit and loss account. So in a trial balance, there may be some account balances remaining after the preparation of trading and profit and loss account, because in case of trading and profit and loss account, we take only expenses and losses. So the assets and liabilities account balances will be there in the trial balance, which is not taken. So balance sheet is prepared with the remaining balances which is not taken in the trading and profit and loss account. So it is called balance sheet. So it shows the financial position of a business on a particular date. So preparation of balance sheet. The left hand side of balance sheet is liability side and the right hand side is asset side. In the left hand side, all liabilities are shown. Liabilities and capital, that is liabilities and owner's equity or capital are shown. And asset side, right hand side is called asset side. All assets are on side shown on the asset side. So now we can explain the groups of assets and liabilities shown in the balance sheet. First one is current assets. Current assets are assets which are in the form of cash or which can be converted into cash within a year. So these are the assets which can be converted into cash within 1 year, short-term assets. Example, cash in hand, cash at bank, bills receivable, closing stock, etc. Then prepaid expenses, outstanding expenses. Prepaid expense means expenses which is relating to a future period but paid in the current year. That is called prepaid expense. Then outstanding expense means the expenses due in the current year which is not paid. Such items are called, outstanding income. Outstanding income is shown on the asset side. Outstanding income, that is income relating to a current period but which is not received during the year, which is called outstanding income. Next is fixed assets. These are assets not meant for resale but are held on a long-term basis in the business. Such assets are land and building, machinery, furniture, etc. So the assets which is held in the business for a long period is known as fixed assets. Next is fictitious assets. These are intangible assets which do not have any money value. Intangible assets means which we cannot see or touch. There are some examples, for example, goodwill. But in case of goodwill have resale value or money value. But in case of fictitious asset, they are actually intangible, but also they do not have any money value. For example, preliminary expenses, accumulated losses, discount on issue of debentures, etc. Next is current liabilities or short-term liabilities. That is liabilities which are to be paid within a year. Such liabilities are bank overdraft, bills payable, etc. Long-term liabilities, liabilities which are to be redeemed after a long period of time. This includes long-term loans, redeemable debentures of a company, etc. Capital, it is the amount invested by the proprietor in a business, which is increased by the profit and decreased by losses and drawings. So, in case of balance sheet or while preparing the balance sheet, we add profit to capital and losses and drawings are deducted from the capital. Next, a contingent liability. Such a liability is one which is not an actual liability, but which will become an actual one on the happening of an event which is uncertain. So the event which is uncertain, if that uncertain event occurs, it will become a liability. It will become a liability. Such liabilities are called contingent liabilities. For example, bills discounted not matured. In case of bill of exchange, bills receivable means it is a negotiable instrument. We can use instead of money, the bill can be used. So, bill discounted means if the bill is drawn for a period of 3 months and if the businessman is in need of money, he can discount it with the bank. Then after charging as proportionate amount or discount, bank gives the amount to the businessman. Such a process is known as discounting of bills. Then on the maturity date of the bill, the party has to pay the amount. If the party didn't pay the amount, the businessman has to pay that amount to bank. It is a liability. It will become a liability for the businessman to pay that amount to the bank. So, it will become a liability on the happening of an event which is uncertain. Usually, contingent liability is not shown on the face of the balance sheet, but it is shown as in a footnote in the balance sheet. This is the format of balance sheet. Left hand side liability side, right hand side asset side. In case of a sole trader, a balance sheet is prepared by showing the short-term liabilities and current assets first. That is short-term liabilities. Liabilities which are to be paid within 1 year are shown first. Then capital and long-term liabilities are shown later. Then assets, current assets are shown first and fixed assets are shown after that. This is the format of the balance sheet of a sole trader. Now we can explain a question. Here the account balances of a trader are given. Only account balance. This is not a trial balance, account balances. And finally, the closing stock is 6,500. You are required to prepare trial balance, trading and profit and loss account, and a balance sheet. So we have to prepare trial balance, then trading and profit and loss account and balance sheet. So for preparing the trial balance, we must know how to prepare the trial balance. The rule first we have to consider is all expenses and asset account have debit balance. Expense accounts and asset accounts have debit balance. So the accounts having debit balance should be written on the debit side of the trial balances. And income accounts, liability accounts and capital account have credit balance. So all the accounts relating to income, liabilities and capital should be shown or written on the credit amount column of the trial balance. So the rule should be remembered that all expenses and asset account have debit balance. While writing the trial balance, accounts relating to expenses and assets should be debited. That is, amount should be written on the debit column. And accounts relating to income, liability and capital should be written on the credit column. So now we can prepare this trial balance. Trial balance as on 31st December 2014. Usually trial balance starts with capital because capital is the initial investment made. So capital account has credit balance. Then while we're writing this trial balance, we have to consider or we have to take care that all expenses and in asset account have debit balance. So we have to classify the items. First, cash in hand. It is an asset. Cash at bank, asset. Land and building, asset. Sundry debtors, asset. Stock, asset. So all these have debit balance. We can check this. Cash in hand, cash at bank, then stock, land and building. All these have debit balances. Look at this. Cash in hand 800, cash at bank 2000, stock 2500, land and building 5000. All assets have debit balance. Then next wages. Wages is an expense, so it is debit balance. It is to be debited. Bills receivable asset. It is to be debited. Interest paid. It is an expense. Expense account have debit balance. It is to be debited. Office expenses. It is to be debited. Rent and taxes. Expense, so it is to be debited. Postage and telegram is also an expense. It is to be debited. Plant and machinery is an asset, so it is to be debited. Purchases, it's an expense. It is to be debited. Drawing. Drawing is capital decrease. While capital have credit balance, drawing is the capital decrease. So it has debit balance. Salaries. It is an expense, so it is to be debited. Depreciation is a loss to the business. It is to be debited. So it is an expense or loss. Next, a furniture asset. So it is to be debited. Repairs expense. So it has debit balance. Bad debt. It is a loss. So it has debit balance. It is to be debited. We can check this. Salaries, debit balance. Office expenses, debit. Rent and taxes, debit. Postage and telegram. All these expenses have debit balance. Power and fuel, interest, depreciation, repair, bad debt. All these are expenses and are to be debited to trial balance. Purchases, debit balance. Then next, creditors. Creditors is a liability, so it will have credit balance. Bills payable, it is a liability, it is to be credited. Power and fuel is an expense, it is to be debited. Let's check these things. Bills receivable, it is an asset, so it is debited. Bills payable is a liability, so it is credited. Then sundry debtors is an asset, it is debited. Sundry creditors is a liability, so it is credited. Then all other assets. Drawing is the capital decrease, so it is debited. Then trial balance is totaled, and if the both sides are tallied or both sides are equal, we can say that it is arithmetically correct. So trial balance is a statement prepared to find out the arithmetical accuracy of the accounts prepared. So if both sides got equal, we can say that it is arithmetically accurate. Next is trading and profit and loss account. Then we are required to prepare trading and profit and loss account and balance sheet. So trading account is usually debited with opening stock, purchases, then direct expenses. Now let's check all these items. Opening stock, then purchases, then we have to find out the direct expenses which are given in the question. First one, wages, direct expense. Then power and fuel. It is a direct expense. That's all. There are two direct expenses only in the question. So opening stock, purchases, wages. No returns are given for purchases. So purchases are directly written in the amount column. Then wages and power and fuel. Then next, sales and closing stock is credited. Sales amount 8,500, closing stock 6,500. We can check the amounts. Sales 8,500. Then closing stock is given the outside the trial balance. Closing stock is usually given outside the trial balance. Closing stock is 6,500. Then we have to total it. That is, first for balancing the account, we have to find out the total of both the sides. Then if the credit is more, we will get gross profit, and if the total of debit is more, we will get the gross loss. Then we have to add all this and we will get more amount in credit side. And the same amount is written on debit side and find out the difference. Then the gross profit is 5,500. Then that gross profit will be brought down. Then next is the preparation of profit and loss account. Profit and loss account is to be debited with all expenses and losses. All expenses and losses are to be debited in profit and loss account, and all incomes and gains are credited in profit and loss account. Let's check the expenses and incomes given in the trial balance. Let's see office expenses, salary, rent and taxes, postage and telegram. All these are expenses. Interest, depreciation, repairs, bad debt. All these are expenses. Then next, these are the expenses in this question. Let's check all these items. Salaries, rent and taxes, interest, office expenses, postage and telegram, repairs, depreciation and bad debts. And no income account balance is given in the question. No incomes are given in. So now we have to balance the account. Then here also credit side is more. Then we write the amount. Then it is same amount is written to the debit side and find out the difference. Then we will get the net profit 2,350, which is to be transferred to capital. Next is the preparation of balance sheet. We are required to prepare trading account, profit and loss account and balance sheet. So balance sheet as at 31st December 2014. Heading is necessary. So the left hand side of balance sheet represents liabilities and right hand represents assets. So in case of a sole trader, short term liabilities are shown first, then long term liabilities and capital. Asset side, current assets are shown first and fixed assets are shown after that. So let's check the items. So short-term liabilities, sundry creditors, bills payable. These are the short-term liabilities. Bills payable, sundry creditors. Then no other liability. Next is capital. Capital 12,500. Capital is increased by net profits and decreased by drawings and net losses. Here the drawing is 1,000 rupees. So a net profit is 2,350. Capital 12,500, add net profit 2,350, less drawings 1,000, we get 13,850. Now asset side. First of all, we are giving current assets. The most liquid item is cash. Cash in hand, a cash at banker. Then other items are sundry debtors, bills receivable. All these are current assets. Cash in hand, cash at banker, bills receivable, sundry debtors. Next, a closing stock. Then fixed assets are shown. Furniture, plant and machinery and land and buildings. Then we have to total the account. We will get the same amount on both sides. This is the preparation of final accounts. So share this video maximum and subscribe my channel.